want you to think about the last time you had to pick and choose which vendor you were going to pay this month. Maybe you were robbing Peter to pay Paul between your business account and your personal account. Maybe you were hoping a client payment would clear before payroll hit. And if any of these sound familiar, then this is going to change how you think about your cash flow, because the reason it's swinging is almost never what business owners think it is. And once you know what's driving it, it's a lot more manageable than you think. When cash flow is constantly swinging, it creates this exhausting cycle where you're always in reaction mode. You're not growing, you're not planning, you're just surviving. And that's no way to run a business that's supposed to be working for you. We're going to talk through what's driving your cash flow to swing, because once you know that, what to do about it usually becomes a lot more obvious. The most important distinction I want you to know is the difference between a cash flow problem and a profitability problem. Because if you're solving for the wrong one, nothing you do is going to work. All right, so I want you to grab a rubber band. Seriously, if you have one nearby, just grab it, because I want to show you something. Hold it between your two hands. And yes, this is the only rubber band I have. Stretch it out slowly in one direction. The further you pull in one direction, the more tension builds up on the other side, right? So that all it's over here. And if you let go, it doesn't just return to where it started, it's gone. It snaps hard. The more tension, the harder it snaps. Cash flow works exactly the same way. Every time money leaves your business before it comes back in, that's tension building on the rubber band. Maybe it's a big inventory purchase you made before the sales come in. Maybe it's payroll going out while you're still waiting on invoices to get paid. Maybe it's an owner's draw that happened before the revenue to support it showed up. Every one of those is another inch of stretch. And at some point, something has to give. Either the cash comes back in and the tension releases, or it doesn't, and now you're scrambling, picking and choosing, stressing, watching your bank account like it owes you an explanation. The rubber band doesn't care why it's being stretched. It just responds to the tension. And cash flow is the same way. It doesn't care if you meant to stretch it. It doesn't care if the reason was totally valid. It just tells you how much tension is there. So the question isn't really, where did all the money go? Or why can't I ever seem to get ahead? The real question is, where is the tension coming from? Because the stretch looks different depending on the situation. And the way you shorten it depends entirely on which one you're dealing with. So let's go through them. The first scenario is one that I see constantly, and it shows up in so many different kinds of businesses. Let's say you're running a business where you're selling products or services to other businesses, and your clients are on net 30, net 60, or maybe somebody negotiated net 90 terms with you, meaning payment isn't due until 30, 60, or 90 days after you send the invoice. That's pretty common. But on your end, your vendors, the people you have to pay to deliver what it is you're providing, they want to be paid immediately. Either you didn't negotiate different terms with them, or they just don't offer them. So you're covering your costs up front on demand, and then you're waiting anywhere from 30 to 90 days to get paid for it. And here's where it gets even more challenging, because it's not just the payment terms you're dealing with. What happens when a client doesn't pay, or they request a refund, or you go to charge them and the payment bounces? Now you've got a bank fee on top of it. You have to chase down another payment, and suddenly you're not looking at 30 to 90 days anymore. You're actually looking at well over 3 months before that money lands in your account, if it ever does. So when you think about the cash flow through your business, it all starts with what you need to spend to build and deliver what you're selling. Your cost of goods, your labor, your software, your supplies, whatever goes into producing that product or service. And then you have to look at how long it takes for that money to come back in, because that window is everything. Here's something a lot of business owners may not think about. If your invoice says payment is due upon receipt. That doesn't mean that you're going to get paid upon receipt. Most businesses have an accounts payable process, which means your invoice comes in, gets entered into their system, goes into a payment queue, and waits for whoever needs to approve it before anything gets paid. If that business pays their bills weekly, maybe you're getting paid this week, maybe next week, depending on when your invoice landed and when it got entered. Having an accounts payable process is the better scenario for you because at least there's a system. If the business you're billing doesn't have a process for how they pay their bills, that can actually get messier and take even longer. Bills can pile up, nobody's tracking them, and they get to it when they get to it, which might be a while. Now, what if the business that owes you money is also struggling with their own cash flow? Because that also happens a lot. And when it does, they're doing the same thing you might be doing, deciding who gets paid this week and who waits. And you might not be at the top of that list. So when clients or customers don't pay on time, it's usually not random. It's generally because they have their own cash flow problem or their business isn't structured in a way that supports paying their bills consistently. You have to think wider than just your own business because what's happening on their end is directly affecting your business. The Federal Reserve found that roughly 4 out of 5 small businesses deal with payment-related challenges. So if this is you, you're not doing something wrong. You're just operating in a system that wasn't designed with your cash flow in mind, and you have to design around it yourself. The businesses that figure this out the fastest are the ones that stop waiting for payment to happen and start structuring their businesses so the money comes in before or during the work. For example, for my own bookkeeping clients, I charge before I even start the work. Every month, the invoice goes out automatically, it charges automatically, and then I do the work. I don't have to think about chasing the money down, and that setup came directly from watching what happens when you don't do it that way. You do the work, the month goes by, you send the invoice, and then you wait. And while you're waiting, you're still paying your team, you're still paying your software, still covering everything it took to deliver that service, and that can get old really fast. So depending on your business model, there are a few ways to go about this. Deposits before the work starts is a big one, even if it's not the full amount. Milestone billing if you're working on longer projects, which means you bill at set completion points throughout the work rather than waiting until the whole thing is done. So cash is moving towards you as you go instead of only at the end. Retainers or recurring billing if your work is ongoing, which is basically a set amount the client pays every month before the work even starts. So you've got a predictable amount coming in on a schedule and you're not starting from zero every time. And beyond how you structure the billing, there are some simple things that make a real difference day to day. Invoice the same day the work is done. Put a payment link directly on the invoice and take a look at whether their payment terms are as short as they can be. A lot of clients will just pay net 15 if that's what you put on there. The point is that before you assume you need more sales or more financing, look at how much time is sitting between when your money goes out and when it's coming back in. Because sometimes the business is fine and you're just structured in a way that keeps you cash strapped. That's the timing scenario. And it's mostly about restructuring how and when you collect. But what about businesses where cash has to go out the door before a single sale ever even happens? That's a different kind of stretch entirely. So scenario 2 shows up more in product-based businesses, restaurants, food service, coffee roasters, basically any business where money has to go out before a sale even happens. And the thing most people don't realize about this one is that the cash isn't necessarily gone. It just changed form. It's sitting on a shelf in a walk-in cooler, in a warehouse, in a bag of coffee beans. It's just not usable yet. And that's what makes it so frustrating because it doesn't feel like a spending problem. It just feels like the money disappeared. Now, there are basically 2 versions of this problem, and I'm going to walk through both of of them because what you do about it is a little different depending on which one you're dealing with. The first version is the bulk purchase problem. This one comes up all the time with coffee roasters and product-based businesses. The way it works is you have to buy in bulk to get a price that makes your margins work. But to buy in bulk, you need cash that you don't have yet because you haven't sold the last batch. So you're constantly in this cycle where you need money to buy product, but the money is tied up in the product you already bought. You can't buy more until you sell what you have, but you're running low, so you have to buy now. And it just keeps going. JP Morgan Chase Institute found that the average small restaurant holds only about 16 cash buffer days. 16 days. So when a large purchase hits and cash isn't moving fast enough, those businesses don't have a lot of runway before it becomes a big problem. So what do you do when you need to front a big purchase and the cash just isn't there yet? There are a few legitimate ways to deal with this. Bank lending or a private lender is one option, but before you go that route, ask yourself whether that loan is going to cover enough product for the business to generate enough profit to pay it back, or if you're just patching a hole, because you can patch a hole in a boat and still sink. And a loan that doesn't move the needle in your revenue is just a bigger bill you're gonna have to deal with later. Lines of credit and business credit cards are also legitimate tools for this, and they can work really well if you're disciplined about it. The key is that the moment cash comes in from selling that inventory, you pay it down because that money is already spent. You cannot spend it twice. Where people get into serious trouble is using the line of credit to buy inventory, watching the cash come in from selling it, and then spending that cash somewhere else before they've paid the line of credit back down. Now you've got debt growing every cycle, and that's when it starts to compound. An investor or equity arrangement is another option for bulk purchasing if it's available to you. And that's where somebody puts money in and takes a percentage of ownership in the business in return. Grant funding is worth exploring also because there are programs out there for-profit and nonprofit businesses across a lot of different categories and industries. So definitely worth looking into before you go straight to debt. One thing I'd really caution you on here is merchant cash advances and revenue-based financing. These can look like a lifeline when you're in a tight spot because they're fast and they don't require a ton of paperwork. But the way that they work is the repayment comes out of a percentage of every sale you make. So the more you sell, the faster you pay it back, which sounds fine until you realize that the effective APR, which is basically the real annualized cost of what you're borrowing, can be around 70% or higher on some of these. You're essentially selling a chunk of every future dollar you bring in. And if your cash flow is already tight, pulling a percentage off every sale can make it tighter and not better. So just go in with your eyes open on that one. Okay, so that's the bulk purchase version. The second version of this scenario is a little different, and it's the waste and over ordering problem. This one hits food service businesses especially hard. You bought more than you could sell before it expired, or before it went stale, or before the week was over, and now that food is in the trash. That food in the trash was cash. You paid for it and you didn't sell it, and now it's gone. A study across 114 restaurant sites in 12 countries found that restaurants cut their food waste by an average of 26% within the first year. How, you may ask? By tracking what is being thrown away, then making changes to how they ordered and handled food based on what they found. Over the 3-year study period, they saw a return of about 7-to-1 on that investment, which tells you that stabilizing cash flow in food service sometimes has not to do with selling more. Sometimes it's actually just about losing less of what you already paid for. A simple place to start is keeping a log of what you're throwing out and why. Was it over-ordered? Did it expire before you could use it? Was it made and not sold? And once you see the pattern, you know exactly where to pull back. For product-based businesses, the same logic applies. If you've got inventory sitting there that isn't moving, that inventory needs to move before you buy more, even if you have to sell it at a discount to get it out the door. Getting something back is better than buying more product on top of products that just sit there. If it's not selling, you have to figure out why. Is it priced wrong? Is it in the wrong place? Is there just no demand for it? Because the answer to that question changes what you do next. With both versions of this scenario, the core issue is the same. Cash went into something physical before the sale actually happened, and the job is to get it moving back out. Sometimes that means smarter purchasing. Sometimes it means financing. Sometimes it means financing the front end while the sales catch up. And sometimes it means selling off what you have before you buy more. But it all comes back to understanding that the cash is there, it just changed form, and figuring out what's slowing it down. Now, timing and inventory are two very real reasons why cash flow swings. But what if neither of those are the problem? What if the issue isn't how cash is flowing at all, but how much of it is leaving? So scenario 3 forces a question to be answered that most business owners really don't want to answer. And that question is this a cash flow problem, or is the business just not profitable? Because cash flow does not equal profit. And what you do about it is completely different depending on which one you're dealing with. A business can have terrible cash flow and still be profitable. That's scenario 1. The timing is off, the structure needs to be fixed, but the business model works. On the flip side, a business can look like it has okay cash flow for a while and still not be profitable because expenses are constantly higher than revenue and debt is covering the difference. And that second situation is where things get really serious, because no amount of restructuring your payment terms or tightening up your inventory is going to fix a business that's spending more than it makes. A lot of times what I see is business owners who are so focused on getting cash in the door that they haven't stopped to ask whether the cash coming in is enough to support the business at its current expense level. And the answer to that question lives in your P&L, which stands for profit and loss. Basically, a report that shows your income against your expenses, not your bank account. Your bank account just shows you what's in it today, and your profit and loss shows you whether the business is working. So are your expenses higher than your revenue month after month? Is the debt that you're carrying going down when cash comes in, or is it growing every month just to keep the lights on? Because if you're taking on more debt every single month just to cover operations, it's not a cash flow problem you're managing. That's actually a signal that the business model itself needs to be looked at. If you took out a loan to cover a bulk purchase and that loan doesn't generate enough revenue to pay itself back, plus leaving some left over for the business, all you've done is bought yourself a little time and a bigger problem. The loan has to make sense for the business to be able to absorb it, or it's just pushing the real issue down the road. Now, sometimes when a business owner really looks at their numbers, what they find is that the business was never going to be profitable the way it was set up. And that's hard to reckon with, especially when you've put a lot of yourself into building it. But the business owners who figure this out and do something about it are the ones who tend to make it. You can always pivot. You don't have to keep doing the same exact thing you started with. Maybe the product mix needs to change. Maybe the pricing was never right to begin with. Maybe there's a version of this business that works and it's not that far from where you are. Pivoting isn't failure. It's just what good business owners do when the data changes. But you can't make that call if you don't know whether the business is profitable or not. A lot of business owners just don't know because their books aren't giving them a clear picture. So if you're not sure, that's the first thing to figure out, because every decision after that depends on the answer. Pull your P&L for the last 3 months. If you don't have one that's accurate, then getting that cleaned up is your starting point, because you cannot make good decisions off a financial picture that's incorrect. Once you can see it clearly, if you confirm that expenses are consistently outrunning revenue, there are only a few options available to you. You either bring expenses down, raise your prices, change what you're selling, or some combination of all three. So look at your biggest expense categories. Figure out which ones are fixed, meaning they stay the same no matter how much you're selling, like rent and insurance. And then which ones are variable, meaning they go up and down depending on how much you're producing or selling, like inventory or labor. And which ones are going out without a clear tie back to generating revenue. That's where you should start. If your pricing was set based on what felt right rather than what covers your costs and leaves something left over, that's the first number to fix, because you can't expense cut your way out of a pricing problem, and you can't outsell a model that was never set up to be profitable. Now, one more scenario I want to cover, and it might be the one I see most often. Sometimes when I start looking at a business's cash flow, the problem isn't the business at all. Scenario 4 is a little uncomfortable to bring up, but I'm not going to skip it because I see it often and it shows up in two pretty distinctive ways. The first is an owner who is pulling more money out of the business than the business can actually support at its current stage. And the second is an owner whose personal and business finances are so mixed together that nobody, including them, can see what's happening in the business. So let's start with the owner's draw situation. Sometimes a business is covering someone's personal life at a level that the business just isn't ready for yet. And I completely get it, because when your business is your income, you need it to cover your life. But if the draw you're taking is more than what the business can support at its current stage, what looks like a cash flow problem in the business is really a personal spending problem showing up inside the business. The money isn't disappearing because something is broken with how the business runs. It's disappearing because more is going out to the owner than the business can handle. This is one of the harder conversations to have, because the answer sometimes is look at what needs to change personally. Can you reduce personal expenses while the business gets to a point where it can support a higher draw? Is there a way to bridge that personally without piling more debt onto the business? Because taking on business debt to cover a draw that's too high isn't stabilizing anything. It's just funding a much larger problem. Now, the second version of this, the mixed personal and business finances, is something I see consistently. And the mess it creates runs far deeper than most people realize. When you're running personal expenses through the business, you've basically made it impossible to know what the business's real financial picture looks like. You can't tell what your real expenses are. You can't tell what your margins are. You can't make good decisions about anything because the data you'd need to make those decisions is buried under a pile of personal transactions. Now, here is step 1. Separate them completely. Business account for business, personal account for personal. Once you do that, the real picture starts to come into focus. And yeah, sometimes what you see when it clears up is uncomfortable, but uncomfortable and fixable are a whole lot better than comfortable and getting worse. Now, there's another one I want to make sure we cover here. One of the most expensive versions of the cash flow problem is when a business owner starts using personal tax withholdings to cover a cash shortfall. Basically, the money gets withheld from employee paychecks. It's sitting in the bank account, and instead of remitting it to the IRS or the state, it gets used to cover something else because cash is tight. I understand why it happens. However, the IRS failure to deposit penalties are no joke. What felt like a short-term solution will turn into a penalty bill that makes the original cash problem look like nothing. Using tax money to float the business isn't managing cash flow. It's actually building a much larger bill that is going to come back to bite you. So across all 4 of the scenarios, whether it's timing, inventory, profitability, or what's happening on the owner's side, every single one of them requires you to know which one you're dealing with, because the approach is different for each. much. And applying the wrong one doesn't solve anything. So here is one central question that every business owner needs to be able to answer about their business. And that question is, do I have a cash flow problem or do I have a profitability problem? Those two things can look identical from the outside. Both of them result in you not having enough money when you need it. The response to each one is completely different. And if you're solving for the wrong one, you're going to keep hitting the same wall. A cash flow problem means the business can work financially. The revenue is there or it's coming, but the structure is off as well as the timing, and money is going out faster than it's coming back in, or it's getting stuck somewhere before it becomes usable. That's fixable by changing how and when you collect, how you manage your inventory, how you structure your financing. The business itself isn't broken. The plumbing just needs to be adjusted. A profitability problem is different. That's when the business model, the pricing, the expenses, or the owner's spending habits don't support the business. And no restructuring of payment terms is going to change that. More sales won't automatically change it either, because in a lot of product-based and food service businesses, more sales means more cost. So you can grow yourself further into the problem if you're not careful. Financing definitely won't help. Financing a business that isn't profitable just means you owe more money than you did before. So how do you figure out which one you're dealing with? You start by asking yourself some hard questions and answering honestly. Is cash coming in, but just arriving late or getting stuck before you can use it? That's a timing issue. Is there cash sitting in inventory or food that isn't moving fast enough to keep up with what you need to spend? That's a purchasing and margin issue. Are your expenses constantly higher than your revenue when you look at your profit and loss, not just your bank balance? That's a profitability issue. Are your owner's draws higher than what the business can support at this stage? That's a cash leaving too fast issue. And is your debt going down when cash comes in, or is it climbing every single month just to keep operations running? That last one is one of the clearest signals there is. A lot of business owners can't answer these questions right now because their books aren't clean enough to tell them. That's not a judgment, it's just the reality. It does mean that the very first step in stabilizing your cash flow is making sure that you have a clear financial picture to work from, because you can't fix something you can't see clearly. And your finances are telling you a story, whether you're reading it or not. The question is whether you're going to read it before it becomes a crisis or after. Cash flow stabilizes when you know where the swing is coming from. It might be your customer payment timing. It might be inventory or food cost. It might be waste. It might be pricing. It might be owner's draw. It might be that the business isn't profitable yet and needs to pivot. One thing that affects all of these, and that most people don't factor in until it becomes relevant, is the accounting method your books are set up on. Depending on whether you're on cash basis or accrual, you might be looking at two very different pictures of the same business. And knowing which one you should be on and why it matters for exactly the kind of decisions we talked about today is what I cover in this video right here. So click there and I will walk you through it.